Why are BlackRock, Visa, and even the world's biggest central banks quietly building on Ethereum? Why is Ethereum, not Solana, not Avalanche, not any new Layer 1, becoming the backbone of institutional blockchain adoption? This isn't about hyper-speculation anymore. This is about integration. The Ethereum Foundation has just launched something called Ethereum for Institutions, a dedicated gateway that speaks the language of banks, asset managers, and governments. And if you understand what's inside it, you'll understand where the next wave of real money is heading. Welcome back to The Block Analyst, the channel where we don't chase trends, we break them down. Today, we're not talking about meme coins or quick flips. We're talking about the infrastructure that's quietly absorbing the traditional financial system. Let's explore the Ethereum Institutional Hub, its hidden message to Wall Street, and how each section reveals Ethereum's long-term plan to become the world's financial operating system. Disclaimer: this video is for educational and informational purposes only. It is not financial or investment advice. Always conduct your own research before making any investment decisions. What Ethereum actually is. Ethereum is not just a cryptocurrency, it's a programmable settlement network. Imagine a global computer that never sleeps, never pauses, and has been online for over a decade, processing billions of dollars daily, trustlessly. That's Ethereum. It's the layer that powers everything from DeFi protocols to NFT marketplaces, DAOs, Rollups, and now the infrastructure for institutions. Ethereum's strength isn't speed or low fees, it's credibility. The network secures over $125 billion in value and has never suffered a consensus failure. It's neutral, transparent, and open source, qualities institutions need if they're going to build the next financial layer. But the question is, how do you make Ethereum, an open, decentralized network, institution-ready? That's what this new initiative answers. Why Ethereum built a portal for institutions. Ethereum's new portal, institutions.ethereum.org, positions the network as the liquidity layer for global finance. It doesn't just promote Ethereum as a blockchain, it sells it as a financial standard. This is the bridge between DeFi and Wall Street, built not by banks, but by Ethereum itself. The message is simple but powerful. Ethereum isn't an alternative to the traditional system, it's the next version of it, a programmable infrastructure where assets, identities, and compliance coexist on-chain. Let's break down what the site presents and what it really means. Section 1. Real-world assets and stablecoins. This section is the beating heart of the institutional narrative. It claims that over 75% of tokenized real-world assets, RWAs, and 60% of all stablecoins exist on Ethereum. That includes tokenized U.S. treasuries, corporate bonds, real estate shares, and fiat-backed digital dollars like USDC and USDT. Why does that matter? Because tokenization turns illiquid assets, like property, gold, or debt, into programmable financial instruments that can trade instantly, settled 24/7, and interact with smart contracts. For institutions, that means efficiency. For traders, that means liquidity. For developers, it means new primitives to build on: yield strategies, collateralized lending, automated treasury management. But here's the catch. Tokenization is only as good as the legal infrastructure behind it. Who audits the tokens? Who guarantees redemption? Ethereum provides the tech layer, but the trust still relies on the issuer. So while this section highlights Ethereum's dominance in the RWA space, it also exposes the biggest challenge: bridging on-chain transparency with off-chain legal certainty. Still, every major asset manager, from BlackRock to Franklin Templeton, has chosen Ethereum as their launchpad. That's not coincidence, it's strategy. Section 2. DeFi for institutions. The next section focuses on DeFi, decentralized finance. Ethereum remains the undisputed core of DeFi, hosting the majority of protocols by total value locked. But the conversation has evolved. It's not about DeFi versus banks anymore. It's about DeFi as the backend for banks. Institutions can now access liquidity pools, yield opportunities, and programmable markets without building from scratch. Protocols like Aave, Uniswap, and MakerDAO are slowly integrating institutional features: KYC-compliant pools, risk-rated collateral, and transparent audit trails. The site frames this as programmable liquidity infrastructure. That's exactly what Wall Street wants: the efficiency of DeFi wrapped in the compliance of TradFi. For developers, this means an entirely new user base, not degens, but corporate treasuries. For traders, it signals larger liquidity inflows, slower money, but deeper pockets. For the ecosystem, it's validation. Ethereum isn't a sandbox anymore, it's a marketplace for real capital. Still, there's risk. Institutional DeFi will likely become more regulated, more permissioned, and less open. The challenge for Ethereum is keeping decentralization intact while allowing this capital to enter safely. Section 3. Privacy and compliance. This section is subtle, but it's the key to mass adoption. Ethereum knows institutions can't operate on public ledgers. They need confidentiality, compliance, and auditability, all at once. Enter the Privacy and Scaling Explorations (PSE) team and the Institutional Privacy Task Force (IPTF). Their mission: build a modular privacy stack on top of Ethereum using zero-knowledge proofs, or ZKPs, and advanced cryptography. This technology allows businesses to prove a transaction's validity without revealing its contents. Imagine a bank that can move funds on-chain while keeping client data private, yet still remain compliant with regulators. That's the holy grail of blockchain privacy, and Ethereum is actively building it. For developers, ZK frameworks like ZK Snarks and ZK Starks become tools for confidential smart contracts. For institutions, they're the bridge between transparency and privacy. And for the ecosystem, this is how public chains compete with private blockchains by giving enterprises both openness and control. Still, adoption won't be instant. Compliance isn't just tech, it's regulation. But this section shows Ethereum is aligning itself with the next wave of compliant DeFi, not running from it. Section 4. Layer 2 Ecosystem. Finally, we reach Layer 2 scaling, the most practical piece for institutions. Rollups like Arbitrum, Optimism, and Base process thousands of transactions off-chain, then settle them on the Ethereum mainnet for security. This architecture drastically cuts gas fees and boosts speed, making Ethereum viable for enterprise-scale use. From an institutional standpoint, L2s mean cost-efficient deployment and scalable transaction throughput. From a trader's view, they mean faster execution and more active markets. And for builders, they offer specialized environments, compliance-ready rollups, private L2s, and even AI-integrated networks. The site frames this as Ethereum's modular future, a base layer for security surrounded by execution layers for every use case: finance, gaming, AI, supply chain, you name it. It's not one Ethereum, it's an ecosystem of interconnected layers, all secured by the same trust anchor. This is how Ethereum expands without fragmenting. The strategic message behind the site. Here's what this entire website really says. Ethereum is no longer trying to convince the world that blockchains work. It's proving they can scale, comply, and integrate into existing financial systems. Every section, RWAs, DeFi, privacy, layer 2, points to the same conclusion. Ethereum isn't just a network, it's becoming the institutional settlement layer of the internet. If Bitcoin is digital gold, Ethereum is digital infrastructure, the rails upon which tokenized assets, stablecoins, and institutional liquidity will move. Implications for builders and traders. For builders, this is the clearest signal yet. Ethereum's next growth wave won't come from retail speculation, it'll come from enterprise adoption. Develop smart contracts with compliance in mind. Integrate with layer 2s. Think interoperability, not isolation. For traders, the takeaway is simpler. Liquidity is consolidating where institutions feel safe. That means Ethereum and its major rollups. Follow the flow, not the noise. Conclusion. Ethereum's evolution isn't a technical update, it's a political one. It's a statement that the future of finance will be public, programmable, and institution compatible. The Ethereum Foundation's institutional portal is more than a marketing move. It's a blueprint for the next decade of financial infrastructure. BlackRock isn't experimenting. Visa isn't testing. They're deploying. And they've all chosen the same base layer, Ethereum. This is the Block Analyst. If you understand what Ethereum is building for institutions, you're already ahead of 99% of the market. Subscribe, stay sharp, and keep watching, because the next hard fork won't just upgrade Ethereum, it'll upgrade the entire financial system.